Greetings from 3 Edge Asset Management in Boston. My name is Fritz Folts, and I'm the Chief Investment Strategist here at 3 Edge. And you are logged into our quarterly webinar for the first quarter of 2020. I'll be doing this webinar with Steve Cucchiaro, who's the President and Chief Investment Officer of our firm. So what we thought we'd do today, a little bit different, is start right off with our poll question, our survey question. Do you believe at the end of this year, on 12/31/2020, the S&P 500 will be higher than where it closed on Friday last week or lower? So you either choose A, you choose B, hit submit, and that will be tallied very, very quickly, and we'll give you the results, and then we'll begin the webinar. So again, before we start, just going to ask the survey question. Where will the S&P 500 close at the end of this year, higher or lower than when it finished, where it finished last week, which was 2789, spot 82. Choose A or B, A higher, B lower, and hit submit. The results will be tabulated, and then we'll see if you are optimistic or not. This is what the poll looks like. Hit higher, hit lower, hit submit. And it pretty much instant, so it shouldn't be much longer. And then we'll get all your results, and then we'll see, and we will move on into the webinar. So what's it going to be? S&P 500 higher than last Friday when it closes at the end of this year, 12/31/2020, or lower? A few more seconds for the rest of the submissions coming in. My guess, Steve, you venture a guess here. I say I guess I can't say higher. Whoa, okay. All right, I was wrong. I was going to say that higher would take the day, but it did not. Very close. Kind of indicative of what the investors are thinking these days. It's just about a tie. I totally agree. So let's get started. Again, welcome to everyone. My name is Fritz Folts, Chief Investment Strategist here at 3 Edge. I'm here with Steve Cucchiaro, who is the President and the Chief Investment Officer at 3 Edge Asset Management. And today, Steve and I will be doing a review of the quarter just ended, as well as providing our outlook for the rest of 2020 and beyond. Before we get started, I did want to point your attention to a couple of what we call thought leadership pieces that we've done. Steve had done a piece, a commentary on February 11th called The Next Bear Market. That was a white paper published on February 11th, and that's available on our website at 3edgeam.com. And Steve and I have also been doing a series of short videos at the end of each week, particularly as the markets react to the COVID-19 global pandemic. Those short videos are available on our YouTube channel. And so you can go to YouTube, search under 3 Edge Asset Management, and you will see the latest videos as well as the entire archive. If you feel free to subscribe to our YouTube channel, and also make sure that you check the bell, the notification button on YouTube, and that way you will be notified upon any new videos as those come out. You can also always follow us on LinkedIn, follow us on Twitter. And lastly, on a monthly basis, I do a podcast with the Director of Research here at 3 Edge, Eric Beagleisen, and what we do there is talk about our outlook and talk about how it might have changed over the course of the month. So that out of the way, let's get started. So it's, Steve, it feels like during the first quarter we had record highs, right? We had record highs, then we had the correction, then we had this massive snapback rally. It feels like we've already had a bull market and a bear market in the course of just over a quarter. So can you give us take us back to what things were like before the bear market, before the correction began in mid-February? Because I think that's important when you try to think about where we are today and where we will be going in the future. So let me turn it over to you for that.
Well, Fritz, our perspective is that before the coronavirus triggered that market plunge, that the U.S. corporate bond market and the U.S. stock market were really accidents waiting to happen. And there are a number of reasons. As you mentioned earlier, I outlined them in the white paper titled The Next Bear Market. And I'll point out that was published on February 11th. The market at that time was still going up and making new highs. It was 8 days before the plunge hit. But what we wanted to point out was that because of the overvaluation that we saw, we didn't know exactly what the catalyst would be. We listed a set of possible catalysts, and then 8 days later, the bear market hit. But one of the key points I should mention goes all the way back to the financial crisis of 2008. And at that time, the Fed created lots and lots of stimulus to get us out of that terrible recession, but they never put things back to normal. Kept rates artificially low. Whenever they try to normalize policy, the market would take a hit and they give up and they go back and put the stimulus back in, keep raising their balance sheet. And so, in our opinion, we've had artificially low rates that encouraged excessive corporate borrowing. That money was not used for capital investment largely or for saving for rainy day. That money was largely used for stock buybacks. So we had not only what we believe was a corporate debt bubble, but then also a U.S. stock market bubble. And if you think about it, that's a perfect situation for the last decade for a very popular investment strategy called 60-40, 60% U.S. large cap growth stocks, 40% U.S. bonds, corporate bonds. And that's been a very popular buy and hold type strategy that's worked very well for the last decade. But because now both the corporate bond market and the U.S. stock market get overvalued, we think that strategy won't work nearly as well in the future as in the past.
Very good. Well, let's take a look at a slide that shows one of the important reasons why we were positioned more defensively prior to the recent correction in the equity markets. Marlowe research indicated that equities in the U.S. equity market in particular was significantly overvalued. So maybe you could take us through this slide.
Yes, well, this slide helps us to explain why we say the stock market was an accident waiting to happen. And as we've done extensive valuation work in all kinds of asset classes, including many different equity indices, we found that one of the very best factors is the price to sales ratio, even better by far than the price to earnings ratio, because earnings can fluctuate widely depending on if the economy is overheated or if it's temporarily down, or other factors where sales are a lot more stable. So what this chart shows is that there's a very good relationship between the times when investors are, you could say, exuberant, or some might say greedy, and times when they're cautious or fearful. Now, this goes back to 1964 and up to the present. The blue line shows the price per share. The yellow line shows the sales per share. And you can see that, as you would expect, as sales per share grows, price per share grows, but not exactly in unison. And so periods like in the 1970s, when that gap widened and people were fearful during that decade and were hesitant to invest in stocks, those, with hindsight, turned out to be the best times to invest. Those were the bottoms of the market. And then times when investors were very exuberant, like right before the tech stock bubble burst or right before the financial crisis of 2008, you can see that the blue line stretches far above the yellow, meaning that those are signs of a lot of overvaluation. Well, the truth is, Fritz, that earlier this year, we reached a gap between the price per share and the sales per share that exceeded any time past, including those times I just mentioned.
Wow. So this is a great follow-up slide to that slide. I think gives you an indication why it's important to pay attention to the price to sales ratio. And maybe you could walk us through this slide.
So there are two important messages we want to give everybody on the slide. One is there's an incredibly strong relationship between the price to sales ratio at a given day and what you can expect the stock market to return over the next 10 years on average. And you'll see on this chart, it goes from 2000 to 2020. The blue line shows the price to sales ratio. You can see on the left the blue scale. The orange line shows the compound annual return that actually happened in the market over the next 10 years. And you can see an inverted orange scale on the right. And like you'd expect, the higher the price to sales ratio, the more overvalued the market is, and the lower the subsequent 10-year returns were. And if you look at the year 2000, we had price to sales ratios over 2, and we had the lowest actual returns over the next 10 years. In fact, they were slightly negative at that time. Then you had a price to sales ratio in early 2009 that was below 1, and you had very high stock market returns over the next 10 years. Well, now we have price to sales ratio, even after the market plunge, almost at 2. And then I did a little bit of work on the side to see, well, with the last rebound we had in April, price sales ratio would be back up over 2. And so this is an indication that people should expect very low returns from the U.S. stock market on average over the next 10 years. It doesn't mean every year will be low return, but it means that the good years will be offset by bad years, and the average is going to be low. And again, we don't think this is good for someone who continues that investment of 60% U.S. stocks and 40% bonds.
Very good. So this brings us to today's environment in the economy and in the markets in the midst of the COVID-19 global pandemic. The slide is titled "A Massive Economic Slowdown versus a Massive Government Intervention." And I feel like every time I have this discussion with people, I keep finding myself saying the word unprecedented over and over again. But maybe you could just help us to understand how these two very powerful forces are facing off against one another and what this could mean for the markets going forward.
I think it's good to think of the situation as a massive tug of war going on, where we have two forces impacting the market in opposite ways, but they're playing out in sequence. So first we had the threat of a severe recession, which we are now in. And we saw the stock market react violently down. In fact, as you said, the steepest stock market decline ever. Then we had, again, to overuse the word, truly unprecedented government intervention into the market between the government, the Treasury part of the government, and also the Federal Reserve Board. And then that was the onset of the very strong rally you mentioned that we just had over the last 2.5 weeks. Mm-hmm. But what we've had is that intervention wasn't that the government reached into all their savings and now are using it to help people and businesses get through this rough patch. The U.S. government's already been in $21 trillion in debt, and in a good year, in a good economy, is adding to the debt level at the rate of $1 trillion a year. So the government had to borrow all the money that it's now using for this rescue package. And who does the government borrow that much money in that short a time from? Well, largely from the Federal Reserve Board. So they've got together in a major way. Federal Reserve Board prints trillions of dollars out of thin air and uses that money to lend to the government so the government can come out with these big rescue packages. The Fed also, in a way that was not only unprecedented, but not allowed until they changed the rules just last week. The Fed is now also able to buy corporate debt, which it never could, municipal bond debt, which even junk bond ETFs. And this was, considered unimaginable in the past. So this kind of intervention has really helped put some support, at least temporarily, in the market. Now, question is it enough? Will it work? And that all depends on the length of the recession. If the optimists are right and we have a V-shaped recovery and the coronavirus goes away in the end of May and the stock market continues to go up, the economy comes roaring back, and people go back to normal, then this bridge will be enough to get across to the other side. However, there are some issues with that. What if we have a situation where we have a change in consumer behavior, where consumers are not full of pent-up demand, but they're cautious, they're tentative? Well, that could delay the recovery. What if we have a second pandemic wave? Well, this certainly will throw everything back into a loop. Now, optimistically, we've got a lot of good technology and work happening in the pharma and bio industries, and maybe we can produce, even before a vaccine, either certain testing or certain medicines that can help alleviate the symptoms, and we can manage through this process. But I remember reading about the pandemic in 1918, so the so-called Spanish flu. After 3 rough months, it went away. People celebrated, they were celebrating in the streets, and then a second wave came back even worse than the first. So we can't rule that out. And finally, one of my biggest fears is if this health contagion turns into a financial contagion. And I say that because before this downturn happened, as I mentioned before, corporations were borrowing at a record pace. Corporate debt in relation to the size of the economy, in relation to cash flow, it was really at an all-time extended record. And what that meant was, as long as we'd never have another recession, companies would be able to fund that debt, roll over that debt, and life would be good. But now we know we have a steep recession. If it doesn't go away very quickly, we could turn what was a health contagion into a financial contagion, and that could keep things on a negative footing.
Very good.
So lastly, we know that history has not been kind to governments.
I'm going to go back to the quote. I'm sorry. Go ahead.
And what that means is that we end up with slower growth. And a lot of research has been done. When history's taken on too much debt is borrowing from the future, and you get slower growth. And then you get a vicious cycle where you're not growing fast enough to pay off your debts.
Right. Sorry about that. I went too fast. So
I went too slow.
Here's an interesting slide, and this gets to gold, which is an asset class that we always pay attention to. Not a lot of investors do. But if you have this sort of battle royal between, the government intervention and the sharp economic slowdown, that could really have an impact on gold, right?
That is very true. Now, when the Fed is tightening monetary policy, that's generally bad for gold because they're creating high real interest rates where you can buy a financial instrument and get a rate of return over and above inflation. You'd rather do that. On the other hand, when the Fed has excessive monetary stimulus or money printing, that's often very good for gold because then you have low or negative real interest rates or inflation-adjusted interest rates, and that's when gold does well. And so you can look in this chart, and over time there's been a very strong inverse relationship between the level and direction of real interest rates and gold prices. And we go back to the early 2000s. Alan Greenspan was so afraid of a Japanese-style deflation hitting after our recession hit in the early 2000s that he lowered rates rapidly, really stimulated monetary policy. And that's when gold was over its 15-plus year bear market and started to climb when people least expected it. And gold did very well until the dollar tightened, until monetary policy started to tighten again. Real interest rates climbed, and gold entered a new bear market. More recently, though, that's all turned around. We're back into high amount of stimulus, money printing. Real interest rates are going down again. In fact, turned negative again. And we think we're still in the early innings of a bull market in gold.
Here's another gold slide. And if I hadn't seen this slide over and over again, I wouldn't have believed it. But it's comparing the performance of gold with that of the S&P over 20 years. So maybe you could walk us through this slide.
Sure. So if I ask the question of a group of people, if 20 years ago you took half your money and put it in the U.S. stock market, the S&P 500 index, with dividends reinvested, you took the other half and put it into gold, 20 years later, which half would be bigger? And I'm sure most people would raise their hands and say, well, that with that length of a time horizon, certainly stocks. But the real answer is gold, and almost twice as valuable. Now, some people point out, well, I picked a year that was a peak in the stock market. Well, we could go back to 1997 and the same thing would hold true. And so the way I interpret that is that gold is not just an investment that works in a crisis period off and on, but it really is a viable long-term investment. And also during periods where there's a lot of monetary stimulus, where there's printing of money, it's generally a great environment gold, whether or not there's a crisis at hand.
Very good. So let's take a look at an equity asset class now that our research model has recently found to be intriguing. And it's an asset class that not many investors pay attention to, and that's German equities. And so maybe you could just explain what our model research is suggesting about the German equity market, the German DAX.
Well, it's interesting. Just as I mentioned that even before the bear market hit, we were seeing great overvaluation in U.S. stocks, and we thought it was an accident waiting to happen. We didn't feel that way about other equity markets. Other equity markets really underperformed over the last decade, and we're not overvalued by our measure, but we're either fairly valued or undervalued. Then when the bear market hit, a market like Germany actually fell even more sharply than U.S. And that brought valuations to be attractive. And in fact, at the bottom of the bear market just a couple of weeks ago, the stock price in Germany, the MSCI German index, actually fell so low that it was a price once seen 23 years ago. So that really was attention getting. And also their stock market has fallen down almost back to book value, which is unheard of, say, in the US. And another indication that there might be limited downside and potential for bounce. So when we did our model calculations after all this happened, we noticed that not only were German equities undervalued, but there was a potential for a bounce, at least in the short term, from this low.
Very good. So I feel like, I may have already said this, but I'll say it again. I feel like it almost feels like we've been through a bear market and then we're back into a bull market now, but that's probably an oversimplification. So maybe if you just took us through the bear markets that you've studied, what might be a typical bear market? So
first of all, the bear market is defined by being a decline in the stock market of at least 20%. And as you know, our research team has analyzed every bear market since the late 1800s. And bear markets could actually fall more than 80%, some have. And so this is a situation where we find that while not every bear market is the same, why every bear market is unique in some aspects, there are attributes that are very similar across them. And one of them is the idea that you usually have three phases. The first phase is a very sharp plunge, very sharp initial down. Then typically when you have some government intervention to try to stop that, or hope from other areas, you get a relief rally, sometimes known as a bear market rally. And that gives people hope that things are all better and the bottom has been reached, people are looking for bargains, and you see the stock market start to climb. And this can last a few days or weeks. This, at one point after the crash of 1929, this actually lasted 4 months. And it draws people back into the market thinking the worst is over. Now, in a case like 1987, which was an exception, it was a rare exception, the recession didn't follow the crash of 1987, and the market continued to go higher in phase 3 with a lot of volatility, but it continued to have an upward bias. However, all the other bear markets, phase 2, the relief rally, was followed by another downturn. It wasn't nearly as sharp as the first phase 1, which is a sharp plunge, but often there was a lot of volatility pointing downward, and in some cases going back to hit new lows. So those are the basic cases of the bear market. And what we find is that in this case, we think that if we have a swift economic recovery, we could have a case like 1987 where we've seen the bottom. And the opposite feel that way. On the other hand, let's suppose that the health contagion does turn into a financial contagion, that all this government intervention is a bridge, but at the end of the bridge, we still have troubles in the economy. Well, then we've got to consider the fact that maybe all the issues are not resolved, and we're going to have phase 3 be another down leg. So what might happen? What's happened in the past? Well, first of all, because of all the excessive debt that the government raised to try to get the economy moving, typically that leads to higher interest rates, and that's bad for the market. That could extenuate the downturn. Now, sometimes you have what we call financial repression. After World War II, we had it where the government didn't want to suffer high interest rates as a way to bail out all the debt that they incurred. So they actually passed laws to cap interest rates at very low levels so that they could pay off their debt with lower refinancing. Now, the Fed can also do it the way they're doing it now, which is they print lots and lots of money, and in their words, without limit. And that could use some of that to buy the bonds, and that could keep interest rates artificially low. But that would be bad for savers. That would be bad for borrowers. That would be bad for bondholders, because in effect, you're being asked to pay and subsidize for the government and others that have been borrowing. What's next? Well, what about higher taxes? This often happens after these episodes. And why higher taxes? Well, if you think back, it's not the Treasury that really owes the debt, as an independent entity. It's not the Fed. It's really taxpayers. We are the ones that owe all this debt. And depending on the political environment, that could be expressed as higher taxes. And then finally, when you have lots of debt, we know that debt borrows from the future, and history shows that when you have excessive debt, you often have slower growth. In addition, with all this money printing that is happening and might continue to happen, that often eventually weakens the currency, and that can cause inflation. And so if we get a period of stagflation, we know that that's also bad for stock and bond markets, but could be good for gold or cash or tips. Now, Fritz, you inspired me of a different way to think about a market bottom, and I'll turn it back to you.
So this is just a quote that I certainly can't claim credit for, but it's really one of my favorite quotes. And basically it says that when you finally get to the market bottom and it comes time to buy, you will not want to at that point. And I do think that's true. And I guess it's kind of interesting because it doesn't feel like we've gotten to that point yet. We'll see. Time will tell. So let's take a look at the quarter just ended, and we'll take a look at the investment performance of the 4 major asset classes. Those that are for the quarter just ended are represented by the dark blue columns, and then there's the 12-month performance represented by the light blue columns. And as we can see, gold and U.S. Treasuries performed quite well, not only for the quarter just ended, but also for the past 12 months, while equities and commodities have both struggled. Let's take a look now at the downturn that we experienced after the mid-February high in the market. So what this slide shows is that peak to trough, the low on March 23rd. So from February 19th to March 23rd, the chart shows the decline or the drawdown of the 3-edge conservative and the 3-edge total return strategies. Those are represented by the top 2 lines on the chart. And then the chart shows the 3-edge multi-asset benchmarks, which are the middle 2 lines on the chart, both the conservative benchmark and the total return benchmark. And then the bottom 2 lines on the chart are the S&P 500 and the ACWI Global Equity Index, both of the 2 bottom lines, both hovering at around down 33% during that very sudden and sharp correction. Our three-edge portfolios were more defensive prior to the decline, which meant that our allocations to equities across our strategies were closer to their minimums. Therefore, our strategies weathered the storm, which we have mentioned was steeper and faster than even the crash of 1929. Now I want to show you one more performance chart. And this looks at performance and also risk measures, right? So the slide shows a comparison of both investment performance and risk measures for the three-edge conservative and the three-edge total return strategies versus their respective multi-asset benchmarks, both for the first quarter of 2020, as well as on an since inception basis, which basically takes you back to January 1st of 2016. So the dark blue columns represent the performance of our strategies. The light blue columns represent the performance of our multi-asset benchmarks. For the first quarter of 2020, the three-edge conservative strategy declined less than its conservative multi-asset benchmark. During the first quarter, three-edge total return strategy also declined less than its total return multi-asset benchmark. So importantly, what we're seeing here is that during 2019, we stuck to our discipline, believing the stock market was overvalued. And by not chasing returns, we fell behind our benchmarks in 2019. However, in 2020, our defensive positioning prior to the recent correction has meant that we have basically caught up to our benchmarks in terms of performance in just one quarter. Now, if you shift your attention to the bottom of this chart, that's where you'll see the risk measures, and you'll see these go back to inception, so back to January 2016. The three-edge conservative and the three-edge total return strategies, as we saw in the upper chart, have similar investment performance to their benchmarks. However, both of those strategies generated those returns while taking less risk. They have lower standard deviations, higher Sharpe ratios, lower maximum drawdowns, and lower correlation to traditional equity markets. So the chart really provides a good example of what we are referring to when we say that we are seeking to generate risk-adjusted returns. Now, Steve, why don't we take a look forward from where we are? Great deal of things happened in the first quarter, but where are we going to go from here? What's our research telling us? And maybe we could just go right through the four major asset groups.
Sure. Well, for frame of reference, there's never been a bigger gap that I can think of in my history of being an investment manager between the optimists and the pessimists about what happens next. And the optimists feel that everything was fine before this correction. The correction was caused by a health issue, and soon we'll be off to the races back to where we were. And then the other extreme is the pessimists feel that this is going to be a lengthy problem, and until a vaccine occurs, we're not going to go back to normal to begin with. Plus, we have deleveraging of an overvalued bond market and all kinds of financial contagion. And some have even called for another Great Depression. Well, we're not as optimistic as the optimists, and because of all the massive government intervention, we hope and don't think that we're going to point to another Great Depression. But where we're at with equities is that even despite the downturn this year, U.S. equities are still overvalued by our measure. However, outside of the U.S., there are some compelling valuations in other markets. And we love to invest in undervalued markets, but we also want to make sure that there's a catalyst, either an economic catalyst or behavioral catalyst. And right now, we saw just before this upturn, our models were pointing to Germany and emerging markets as two areas where we certainly had undervaluation. And then there was some catalyst present to expect some kind of a rebound in those two areas. But this is subject to change. The markets are fast moving, the economy is fast moving, and so we're watching that research very closely. In terms of fixed income, this really depends a lot on what we think of in terms of rates and spreads. So because we believe interest rates and credit spreads are artificially low because of all the Fed stimulus, both in history and more recently, we think it's time to play defense in fixed income, not reach for higher yield and take on a whole lot more risk, because we don't think that investors are being compensated fairly for that risk on the corporate bond market, especially at the junk bond level. We think it's too premature. And then as far as interest rates go, we certainly think that interest rates have further to climb over time, looking out ahead, than they have. There's just not a lot more they can go down. So we think it's not good to have long duration in fixed income. We think it's not good to take on credit risk. So in fixed income, we're playing defense, and we're sticking toward shorter term treasuries, which we think is safer.
And how about real assets?
Now, with real assets, we think these are ideal conditions for gold over the long term. Gold thrives when the Federal Reserve Board and other central banks are practicing very loose, stimulative monetary policy. And the Fed just recently said they're willing to print money without limit. And it's hard to imagine a more favorable environment over the long term with gold. And the only thing that could happen in the short term is what we witnessed when the market plunge began in late February. And that is that when the equity markets were going down, there's so many investors that were over leveraged, that had too much in equities, that were considering that the stock market would never go down again. And that kind of complacency, they borrowed a lot of money. And then when the market did get hit, they needed to sell their gold to raise cash to either pay off their margin loans, pare down their debt, or to cover the losses from their stocks. So if we have another leg down, it's possible we see that again. But we think most of that is behind us. And finally, with commodities are very intriguing. As one would expect, commodity prices are very low right now. And you would expect that when we're back into a steep recession today. We know that. We don't know how long it's going to last exactly. But this is certainly bad for commodities demand and commodities prices. On the other hand, as we measure commodity valuation and performance relative to all the other asset classes, there's never been a time where commodities are more undervalued than they are now. So the catalyst might not be quite there yet, but when there's ever any visibility that the economy is going to stabilize, commodities can be a very interesting, attractive, undervalued asset class.
Very good. Excellent. Thank you for that. So now, well, first we'll get, so this is a picture, if you will, from, we happen to use the platform Microsoft Teams. And as everyone out there, we have been communicating virtually, but we're able to have meetings, we're able to do calls, we're able to chat. It's pretty amazing what you're able to do with the technologies these days. Steve and I will be back at the conclusion of the second quarter of 2020, which will be in early July, which frankly seems like a lifetime away at this point in time. But on behalf of Steve and everyone at 3Edge Asset Management, please stay safe and stay strong and keep the faith during this very difficult times. And thank you all for listening.
Thank you.